U.S. stocks staged a dramatic rebound today, led by the semiconductor sector, following a sharp sell-off last Friday. Investors are now grappling with the implications of inflation data due later this week. Here's a detailed look at today's market movements. Looking ahead, the next major test for the market will be the Consumer Price Index, CPI, inflation report scheduled for release later this week. This report is particularly significant as it provides a comprehensive measure of inflationary pressures within the economy. Analysts are divided on what the data will reveal, with some predicting an increase in inflation that could reignite fears of further interest rate hikes by the Federal Reserve. Such a scenario would place additional pressure on the semiconductor sector and tech stocks, which have been particularly sensitive to shifts in interest rates. Conversely, a cooler inflation report could bolster investor confidence, potentially leading to an extended bullish trend in the market, especially for growth-oriented sectors. Contextually, inflation has been a persistent concern in the post-pandemic recovery, with supply chain disruptions and rising demand contributing to upward price pressures. The Federal Reserve has been navigating this challenging environment, balancing the need to control inflation while supporting economic growth. Experts are closely monitoring indicators such as Treasury yields, which have been fluctuating in response to inflation expectations, as well as other economic signals that might provide clues about future trends. The impact of the CPI report could be profound, influencing not only investor sentiment but also shaping monetary policy decisions. If inflation is confirmed to be higher than anticipated, it could lead to more aggressive rate hikes, potentially stifling economic growth. On the other hand, a more favorable report could provide relief and support the ongoing recovery in the tech sector. As we approach the release, one crucial question remains. Will the upcoming inflation data confirm fears of an overheating economy, or will it provide the necessary relief to sustain the tech sector's recovery? Investors are keenly awaiting clarity on this pivotal issue. The road to today's stock market rebound has been paved with volatility and uncertainty. In recent weeks, the stock market had been on an upward trajectory, primarily fueled by optimism surrounding artificial intelligence technologies and significant investments in semiconductor stocks. However, Friday's sell-off served as a stark wake-up call, triggered by a confluence of factors. The May jobs report revealed stronger than expected job growth, which raised alarms about potential economic overheating. This unexpected surge in employment, while positive on the surface, ignited fears that the Federal Reserve might need to ramp up interest rate hikes to curb inflation. Compounding these concerns were disappointing earnings reports from key players in the semiconductor industry, notably Broadcom, which issued a weaker than expected outlook. This shift in sentiment caused a dramatic retracement in a market that had become heavily reliant on tech sector growth. Historically, markets have faced similar pressures during periods of economic transition, such as in 2020, when tech stocks encountered significant headwinds due to evolving economic indicators. This time, the Federal Reserve remains a pivotal player in the narrative, skillfully navigating the complex balance between combating inflation and supporting economic recovery. Investors are particularly anxious about the Fed's next moves, as the central bank's decisions will weigh heavily on market stability. The current landscape suggests that while the stock market may experience further fluctuations, a return to stability could hinge on the Fed's ability to instill confidence among investors. Looking ahead, market participants will closely monitor economic indicators, particularly labor statistics and inflation data, as well as upcoming corporate earnings reports. These factors will be crucial in shaping investor sentiment and determining the market's trajectory in the coming months. Today, the stock market experienced a notable rebound, a development that carries significant implications for investors and the broader economy. The semiconductor sector, which has been a pivotal driver behind the recent surge in artificial intelligence-related equities, is particularly crucial for the overall market's health. Last Friday's sharp decline in semiconductor stocks triggered alarm bells among investors, highlighting their integral role not only in technological advancement, but also in reflecting overarching economic trends. This recovery signals a potential reassessment of investor fears surrounding interest rates and inflationary pressures that have been dominating market discussions. The semiconductor industry is often viewed as a bellwether for tech growth, representing a substantial portion of the S&P 500 index. Recent estimates indicate that approximately 30% of the S&P 500's impressive gains this year can be attributed to technology stocks, especially those linked to AI innovations. This underscores the importance of semiconductors, which are essential components in everything from smartphones to advanced computing systems. A downturn in this sector could have far-reaching consequences, dampening investor sentiment and potentially stifling capital investment in vital areas such as AI infrastructure and development. The interconnectedness of these sectors emphasizes the importance of monitoring market movements closely. If inflation data released later this week reflects ongoing pressure, it could reignite fears, leading to renewed volatility in semiconductor stocks and, by extension, the broader market. Investors are acutely aware that the Federal Reserve's monetary policy decisions are heavily influenced by inflation trends. A continuation of high inflation could force the Fed to adopt a more aggressive stance, raising interest rates and further complicating the investment landscape. Looking ahead, the upcoming Consumer Price Index (CPI) inflation report will be crucial in shaping market dynamics. Investors should prepare for potential fluctuations as they digest this data, which will likely influence the Federal Reserve's next steps. A favorable CPI report could bolster confidence in high-growth technology investments, while an unfavorable one might lead to a reevaluation of risk in the semiconductor sector. As the market navigates these complexities, all eyes will be fixed on the interplay between inflation, interest rates, and technological growth, which will determine the trajectory of investment strategies in the coming weeks. On June 9, 2026, U.S. stocks experienced a notable rebound following a sharp decline on Friday. The semiconductor sector was at the forefront of this recovery. By mid-afternoon, the S&P 500 index had risen approximately 2.3%, with semiconductor stocks like Marvell Technology and Micron Technology leading the charge. This recovery came after Friday's sell-off, which ended a 9-week winning streak for the S&P 500. The drop was triggered by stronger-than-expected jobs data, which pushed Treasury yields higher. Investors feared that the Federal Reserve may need to maintain elevated interest rates or even hike them again to combat inflation. This sell-off was particularly concerning as it affected the very market segment that had been driving gains for the past weeks, namely technology and AI-related stocks. Notably, Friday's downturn was fueled by multiple factors. A robust May jobs report indicated a tightening labor market, concerns about the economy overheating, and disappointing earnings guidance from chip manufacturers such as Broadcom. The sharp decline in the semiconductor sector was shocking, especially considering its previous strong performance tied to the AI boom. The volatility seen in tech stocks underscores the fragility of investor confidence in a rapidly changing economic landscape. As companies in the semiconductor space are often viewed as bellwethers for technology, their struggles can reverberate throughout the entire market. Investors are now grappling with the reality that sustained high interest rates could dampen growth prospects across various sectors, especially those reliant on heavy capital expenditures like technology and manufacturing. Looking ahead, the market's recovery will hinge on the upcoming Federal Reserve meeting and any signals regarding future interest rate policies. Analysts are closely monitoring inflation trends and economic indicators to gauge whether the Fed will adopt a more dovish stance or stick with its current strategy. The semiconductor sector, still buoyed by the AI revolution, faces a crucial test in the coming weeks. If companies can navigate these economic challenges and deliver solid earnings, investor sentiment could shift back positively. However, any signs of economic weakness or aggressive rate hikes could lead to further volatility. Specifically, the next earnings reports will be pivotal in determining whether the sector can sustain its momentum amidst rising economic pressures. As we await the CPI report, will it validate the fears about inflation or support a continued market recovery? Share your thoughts in the comments below and subscribe for more daily deep dives.